One of the advantages of ETFs can be low cost, efficient investing tied to an index. Our guest says that a lot of investors now are looking to ETFs, not just for low fees, but because the prospect of actively managed strategies can improve your returns. We're joined now by Skyler Weinand, Chief Investment Officer at Regan Capital. Skyler, thanks very much indeed. Just tell us about your company. You're an ETF provider. Are you just in the US market, or do you offer any products in Canada?
We're based in Dallas, Texas. We manage about $3.7 billion, over half of which is in 40 Act funds. We have a large mutual fund. We have 2 US-based ETFs, and we also have a UCITS-based vehicle for non-US investors. And our view on mutual funds versus ETFs is a little bit nuanced, but ETFs are definitely the way of the future for liquid fixed income products.
So let's talk about 2 products you have here. We'll start off with a thing called MBSF. Now, sure. It addresses the gigantic agency mortgage bond floating rate market. And we're looking at a chart there for it. So what's it designed to do?
You have about $500 billion in agency floating rate mortgage bonds. Okay, this is traditionally a bank product. If Silicon Valley Bank owned floaters in 2022 and 2023, they would have been fine. But back then, they went out and they bought fixed rate paper for an extra 20 to 40 basis points. So you have this large market that has very, very little interest rate duration, very little interest rate risk, but it's government guaranteed, backed by the strength and the security of the United States government, or GSEs, government-sponsored enterprises, Fannie and Freddie. So you get monthly floating rate income with no credit risk because they're backed by government guaranteed mortgage backs. Yields currently are high 4s. So you're picking up a point to a point and a half over U.S. Treasuries. And so this market got beat up a little bit post 2021 and 2022 when the Fed started raising interest rates, only because there was a lack of buyers. Pre-2021, you were barely getting 25 basis points over Treasuries. Now you're getting roughly 100 basis points over Treasuries.
Let's have so you've told us about that one. Tell us about MBSX. What do you reckon this offers investors?
Right. So we offer a sister fund, MBSX, which is MBSX. We call it MBSX because it's fixed rate. Okay. So MBSF is the only floating rate agency fund in existence. Okay. Now, MBSX, there are a number of mortgage-backed ETFs that are focused on the index. Okay. And the index is very bifurcated between bonds that were issued 2 to 3% coupon bonds from post-COVID, okay? Those borrowers are never going to move. They're never going to refinance. And so there you're buying really long duration paper. And then there's new issue paper where the borrowers are refinancing a ton. There's this middle road where you can buy the best securities at 85 to 90 cents on the dollar with tremendous upside, and yet keep your duration at 2 to 3. So MBSX really is our best ideas on the fixed rate side. And the fixed rate side, fixed rate mortgage backs, is over $10 trillion. And when you think about how large of a market that is, there's very little differentiation with the current outstanding funds, especially ETFs. There's only 4 or 5 ETFs that focus on this space. For how large it is, it's really amazing. And so what you're getting is Regan being able to actively manage, run these assets 2 to 3 year duration, but also have tremendous upside to prepayments.
I'm just looking at a comparison, return comparison, on Bloomberg here. Going back to May 1st, of last year, which is, I think, when you launched MBSX, if I'm not wrong. Yeah. So that one has done better. Its total return, almost 9%, compared with about 4.5% for MBSF. And certainly they both outperformed TLT, which is a classic. It's a different beast, I know, but it's a classic 20-year bond ETF. Why has MBSX done better?
Yeah, the nature, what really happened last year is, yes, rates came down. So even owning the index you made 7 to 8% because rates came down roughly 65 basis points. But they particularly came down in the belly of the curve, 2 to 7 year.
Well, sorry,
whereas
what?
TLTs focused on the 20+ year part of the curve.
Sorry,
that part of the curve actually went up.
Sorry, Skyler, but I interrupt you. What does belly of the curve mean again? Just remind us. Sorry.
You have T-bills, which are 0 to 1 year. Okay. The belly refers particularly to the 2 to 7 year part of the curve.
Okay.
Whereas the long end of the curve, which is 10 to 30 year, that's if you want exposure there, you're going to go by TLT. Okay. And so the belly really is where most money managers are going to be located in terms of duration. They want somewhere between, let's say, a 3 and 6 year duration. The index is about 6 year. So long story short, because of the duration within MBSX and fixed rate products in general, they outperformed last year, but that's the first year they've outperformed versus floating rate in a long time. Okay. Floating rate's always going to have a place in bank, insurance company portfolios. But generally speaking, when people think of fixed income, they think of a fixed coupon, some interest rate risk. On a go-forward basis, you're going to want to be 50-50 between floating and fixed rate. But that's really an anomaly in the market because when you think about treasuries, corporates, and mortgage backs combined, you're talking about a $50 trillion market. Only about 4 to 5% of that market is actually floating rate. So MBSF offers exposure to the floating mortgage-backed securities.
Skyler, thank you very much indeed. We learned more about the U.S. fixed income market. I really appreciate it. Skyler Weinand, Chief Investment Officer at Regan Capital.